All right, thank you so much for joining another My Solo 401k Financial YouTube webinar. We've got a great presentation planned. We're waiting for the viewers to join. We're about to get started. We're just going to verify the audio. All right, today's presentation is regarding the 2022 and 2023 Solo 401k Contributions Guide deep dive webinar that is geared for sole proprietors, single member LLCs, those freelancers, independent contractors who receive a 1099 NEC and report their income as a single member LLC on Schedule C of their 1040. So if you're on YouTube, thank you so much for joining. You're able to chat over questions if you're on YouTube. If you could please like and subscribe, we would appreciate that. We're going to be having more of these deep dive sessions as we're in the middle of contribution season. As those who set up a plan, for example, by the end of December 31st, 2022, preserve the right to make all types of contributions up until their business tax return deadline here in 2023. All right, so first of all, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. All right, so we got some questions being chatted up. Thank you so much for bringing the good questions. I want to highlight some resources. Go ahead and keep chatting questions up as we go through. I do want to take a moment to highlight some good resources. For example, we go live every day on our community. We host a Zoom where you can come and ask questions. It's totally free to join. You can post questions 24/7 in our forums. We are, as well, we post videos on our community. We post videos every day on this YouTube channel with questions from the community. So I'm going to go ahead and chat over a link to the community. If you'd like to join and participate, it's a great way to engage and to learn and to share the knowledge. All right, so now let's talk about what we're going to go through in this session. So again, we're focused on 2022 and 2023 Solo 401k deep dive contribution guides, specifically geared for those who are taxed as a sole proprietor, a single member LLC, a 1099 independent contractor. We're going to really go through A to Z, the contribution limits, including a Secure Act 2.0 update. We're going to then apply what we've learned from those contribution limits to different scenarios and examples. We're going to talk about our online calculator because it's a great resource. We're going to keep talking about the mechanics A to Z. So the deadline, how to make the contributions, how to report the contributions. And then lastly, we're going to kind of clarify what's not a contribution. So some potential points of confusion. So the focus of the presentation, sole proprietors, single member LLCs, Schedule C, 1099, independent contractors. If you have if your business is taxed differently, like say it was taxed as an S or a C, if you go to last week's presentation, we did a deep dive presentation focused on those types of businesses. The next presentation we're going to give is going to be geared towards self-employed people whose business is taxed as a partnership. So anytime we're talking about how much I can contribute, it's good to understand that the ability to contribute is based on certain factors. And of course, you start with, okay, your income, your self-employment income, because the purpose of a solo 401k really is for a self-employed person to save their earned income. And you can't save more than you earn. So you've got to have self-employment income to justify the contribution. Another factor is your age. As you'll see as we go through the presentation, if you're 50 or older, you're able to contribute more because you're able to make what's called a catch-up contribution. Next is whether you participate and make contributions to another plan. So think like a 401k plan through a day job. Another important consideration is the type of contribution. So when you're self-employed, you're both the employee and the employer. You can make both types of contributions. In addition, if you have a plan like our plan, which allows for pre-tax, Roth, and voluntary after-tax, which is how one makes Mega Backdoor Roth contributions, then you're going to have to consider which type of contribution that you're looking to make when you're deciding how much that you can contribute. So now let's dig in and start to go through these different factors. So number one, self-employment income. So again, we're focused on sole proprietors, single member LLCs, 1099 independent contractors. So where the income, your self-employment income, is reported on Schedule C of your 1040. For those type of self-employed businesses, the individual has to run a pre-calculation to determine self-employment compensation. So that pre-calculation is going to consist of taking your net income from line 31 of Schedule C less 1/2 of the self-employment tax. So it's helpful to consider, okay, what's not self-employment income? So for example, W-2 wages that you receive from a day job, that's not self-employment income. Investment income, like income that you might be reporting on Schedule E of your 1040, that's not self-employment income. So here's a good slide that really shows exactly what we're talking about. So you take your net income, your net profit, excuse me, from your business. So you want to use line 31 of Schedule C. That's where that net self-employment income is reported, less 1/2 of the self-employment tax. And our Solo 401k calculator does this for you. We also are fielding questions every day from clients, helping them figure out and educating them on the contribution limits and the rules, etc. So once you know your self-employment income, now you're able to figure out, okay, how much can you contribute? And the second determination is, okay, what year are you looking to contribute for? Because the contribution limits change year to year. And you can see that there was a big jump from 2022 to 2023. This is the consequence of inflation, right? Because the consumer price index goes up. The idea is that it costs more to live. You need to save more for retirement. We need to increase those contribution limits so that individuals are able to save more. So for 2022, the annual contribution limit was $61,000. And if you're 50 or older and you have the self-employment income to justify it, one is able to make an additional catch-up contribution of $6,500. Where as for 2023, it went up from 61 to 66 as the overall limit, plus the catch-up contribution went up from $6,500 to $7,500. And we'll see how this plays out in the scenarios. But first, we're going to keep laying the groundwork with the different contribution types and the limits, etc. So now the next consideration, okay, how much do I make? What year am I looking to make this for? What type of contribution am I looking to make? So let's go through the different types. Number one is employee contributions. So employee contributions, those can be made as pre-tax, where that's reducing your taxable income, Roth, where it's not reducing your taxable income, but you've got the potential for tax-free growth if you're able to take a qualified distribution once you finally take the money out of the 401k account, or voluntary after-tax contributions, or a combination of all of the above. So Roth and pre-tax contributions, those are impacted by the day job 401k plan contributions. In other words, the employee contribution limit applies at the employee level. So if someone has a job at Microsoft and then they have a side, say, business that's engaged in web hosting for which they have a solo 401k, if that individual maxes out their contributions to their day job plan at Microsoft, they're not going to be able to make any more employee contributions to the solo 401k because that employee limit applies at the employee level. Now, that applies when we're talking about Roth or pre-tax contributions. If the individual wants to make voluntary after-tax contributions, because of the way that voluntary after-tax contribution limit works, that voluntary after-tax contribution limit actually applies at the employer level. So even though that individual might be making contributions to another 401k plan that's sponsored by an unrelated employer, like Microsoft in our simple example. If they have the self-employment compensation to justify it, they're still going to be able to make voluntary after-tax contributions to the solo 401k. And we've got a few examples to illustrate this point. So we talked about how when you're self-employed, you're both the employee and the employer. So in addition to being able to make employee contributions, the self-employed person can also make employer contributions. So historically, employer contributions have always been pre-tax contributions. Now with Secure Act 2.0, it is technically possible to make employer contributions as Roth contributions. And we're going to talk about why there's really no advantage to making those employer contributions as Roth contributions when one has a plan like ours that allows for Mega Backdoor Roth contributions in a few slides. But we'll put a pin in that for now. But just to introduce the concept of employer contributions, yes, you can make technically as either pre-tax or Roth. Employer contributions are not affected by contributions made to another plan sponsored by an unrelated employer, like the day job plan. So even if you've maxed out your Microsoft 401k contributions, that self-employed individual could still make employer contributions to their solo 401k without consideration for those contributions that were made to the Microsoft plan. Next is Roth contributions. So those may be applied as employee contributions, right? That's we talked about up above with the employee contributions. Technically could be a Roth, but again, there's no significant, technically it could be made via an employer contribution, but again, we'll talk about why there's no significant advantage to do so for our type of plan that allows for Mega Backdoor Roth. When one is making a employee contribution as a Roth contribution, and one is 50 or older, then they're able to include that catch-up amount as that Roth employee contribution. Lastly, you've got voluntary after-tax. So voluntary after-tax are technically a type of employee contribution, but the limit is different. It's higher, right? As we'll see, you can go all the way up to the overall limit. And because the limit is different, because you can go all the way up to the overall limit, it's not impacted by any contributions that are made to a day job plan. At the same time, even if you're 50 or older, the overall limit doesn't go up. So one is not able to make the catch-up contributions as a voluntary after-tax contributions. Instead, they're either made as a Roth contribution or as a pre-tax contribution. So as you can see, there's a lot of issues playing out here. This is why it's going to be so helpful to stay tuned as we go through the different scenarios to really see how these rules work and apply. Okay, so our next slide, our next set of slides, we're going to really go and drill down and talk about the limits for each of these different types of contributions. So we're going to start with employee contributions. How much can I contribute? And we're going to focus on someone who's looking to make employee contributions as a pre-tax contribution. So employee contributions are also referred to as salary deferrals. So the limit is 100% of the self-employment compensation not to exceed $20,500 for 2022, plus an additional $6,500 if you're 50 or older. So remember, self-employment compensation is equal to line 31 of Schedule C less 1/2 of the self-employment tax. So after one has run that calculation, assuming that they don't make contributions to another plan like a day job plan, they're going to be able to contribute 100% dollar for dollar up to $20,500 for 2022, plus an additional $6,500 if they're 50 or older. For 2023, that limit goes up to 100% of self-employment compensation up to $22,500, or an additional $7,500 if they're 50 or older. So potentially it could go all the way up to $30,000 as an employee contribution. Per that first sub-bullet, you do need to reduce by any contributions made to another plan, because that employee limit applies at the employee level, with the one exception that if the other plan is a 458 governmental plan, you don't have to reduce. The contributions are not aggregated. So the employee contribution, the salary deferral, could also be made as a Roth contribution. Either you could do all pre-tax, you could do all Roth, or you could do some combination of both. If one is going to be making Roth employee contributions, those contributions have to go into a separate Roth Solo 401k sub-account. So if one has both pre-tax and Roth, now they've got two accounts. And again, the catch-up contribution could be made as a Roth employee contribution. So the $6,500 for 2022 and the $7,500 for 2023 if one is 50 or older. So now let's talk about employer contributions. Employer contributions are also referred to as profit-sharing contributions. So the limit for employer contributions is 20% of the self-employment compensation. If we're talking about a self-employed business where it's taxed as a sole proprietor or a single member LLC or a 1099 independent contractor where the self-employment income is reported on Schedule C. So remember, you have to run that pre-calculation. Line 31 of Schedule C less 1/2 of the self-employment tax. Of that number, one is going to be able to contribute 20% of the self-employment compensation, provided that the sum of all the contributions made to the Solo 401k plan, so any employee contributions, any after-tax contributions, plus the employer contribution doesn't exceed the overall limit. So the aggregate contributions can't exceed the overall limit. Again, that's $61,000 for 2022, plus an additional $6,500 if you're 50 or older. For 2023, that overall limit went up to $66,000 or $73,500 if you're 50 or older. Recall that contributions made to the day job plan, like in our simple Microsoft example, are not going to reduce one's ability to make employer contributions to the Solo 401k. So these employer contributions historically you've had to make those as pre-tax contributions. Now with Secure Act 2.0, there is the ability technically to make the employer non-elective contributions as Roth contributions. For a Solo 401k plan that allows for Mega Backdoor Roth contributions, like our plan, this change offers no substantive advantage. Why is that? Well, number one, voluntary after-tax, with a plan like ours that allows for Mega Backdoor Roth, technically what one is doing is making voluntary after-tax contributions and then moving the funds from the voluntary after-tax sub-account to the Roth account. So that's why they refer to it as the Mega Backdoor Roth, because ultimately the funds end up in your Roth Solo 401k. So if the goal is to make Roth contributions, we're going to explain why making those contributions, making those employer contributions as Roth contributions doesn't present any substantive advantage over what you're already able to do with our plan by making after-tax contributions that are then transferred to the Roth account. And why is that? Well, number one, voluntary after-tax contributions can be made at a higher percentage of self-employment income, 100% dollar for dollar, versus as we saw, when one is making employer contributions, one is limited to 20% of the self-employment compensation. So in other words, you're going to be able to get faster to your Roth contribution goals and the limits. The deadline to establish a Solo 401k plan in order to make employer and or voluntary after-tax contributions is the same. So there's no advantage from a deadline perspective. The plan needs to be established in time to make the contributions by the business tax return deadline, including any timely filed extension. In other words, even if you haven't set up a plan for 2022, if you set up the plan in 2023 in time to be able to open accounts and make contributions by your business tax return deadline for 2022, including any timely filed extension, then you could still open up an account and make 2022 employer as well as 2022 voluntary after-tax contributions. So making those employer contributions as Roth contributions doesn't present an advantage from a deadline perspective. Lastly, you have more flexibility with voluntary after-tax contributions. For example, voluntary after-tax solo 401k funds may be transferred to a Roth IRA with no triggering event required. Whereas if your goal is to transfer funds to a Roth IRA and you made those employer contributions as Roth contributions, they're not going to be able to be transferred out of the solo 401k to a Roth IRA until a triggering event has been met. For example, attaining at least age 59 and a half or more or greater. So let's answer some FAQs that you might have related to the new Roth employer non-elective contributions. Do I need to deposit the employer solo 401k contributions made as Roth solo 401k contributions in a separate account? No, you don't. You, of course, have to keep them in a separate Roth account, but both the employee and employer contributions made as Roth solo 401k contributions may be deposited into the same bank or brokerage account for Roth solo 401k funds. Next FAQ, what is the contribution limit for employer solo 401k contributions made as Roth solo 401k contributions? So the contribution limit is the same for both pre-tax and Roth employer solo 401k contributions. In other words, again, it's 20% of your self-employment compensation subject to the overall limit. How do I report employer solo 401k contributions made as Roth solo 401k contributions on my personal or business tax return? Great question. At this point, there's no specific IRS guidance yet. However, there's no specific guidance yet on how to report Roth employer solo 401k contributions. We would note, though, that it would not be prudent to report those contributions as deductible expenses, since the contributions are made on a Roth, meaning post-tax basis. All right, and I see that we've got questions that are continuing to stack up. That's fantastic. We're going to keep going through the slides, and once we get to the end, we'll turn to all the good questions. So now let's keep going with our contribution limits breakdown, and then we'll start to apply these limits with the scenarios to really illustrate how they work. So lastly, we're going to talk about the voluntary after-tax contribution limit. Voluntary after-tax contributions are how one makes Mega Backdoor Roth contributions. So the voluntary after-tax solo 401k contribution limit is the lesser of one's self-employment compensation or the overall limit. In other words, one is able to contribute 100% of their self-employment compensation, dollar for dollar, up to the overall limit. So the overall limit for 2022 is $61,000. It went up to $66,000 for 2023. Now, of course, since that's the overall limit, you have to reduce how much you can contribute as a voluntary after-tax contribution by any employee or employer contributions made to the plan. Note that you ignore the catch-up contributions. So you don't have to reduce how much you can make as a voluntary stated differently, you're not able to make additional, because one is 50 or older, you're not able to make the additional, say, $6,500 or $7,500 as a voluntary after-tax contribution. You still have to make that as a pre-tax or Roth employee contribution. But when you're making the voluntary after-tax contributions, you don't have to reduce how much you contribute as a voluntary after-tax contribution. So effectively, you're still, if you have the self-employment compensation to justify it, you're still able to get to those higher limits, right? Like the additional $6,500 for 2022 and the additional $7,500 for 2023. Please note that the ability to make voluntary after-tax solo 401k contributions is not impacted by contributions made to another plan through an unrelated employer, like a day job 401k plan, unless the other plan is a 403b. If you're making contributions to a 403b or contributions are being made on your behalf to a 403b, then you do have to aggregate those contributions and consider those contributions when determining how much you can contribute to the solo 401k. Lastly, please note that voluntary after-tax contributions need to be deposited into a separate sub-account for each participant. This is how you end up with 6 different sub-accounts if you have 2 participants in the solo 401k, like say a husband and wife that are both working in the same business, because each person that's participating in the solo 401k may have a pre-tax, a Roth, and an after-tax solo 401k sub-account. All right, now we're going to go through the scenarios, and we're going to first start out with defining the base scenario assumptions, and then we're going to start to tweak the different assumptions to illustrate how the rules work. So the base scenario is that one, you have a self-employed business, again, taxed as a sole proprietor, single member LLC, or a 1099 independent contractor. It's one person who's under 50 years of age, does not make contributions to another plan like a day job plan. Their goal is to first maximize pre-tax contributions, and then if they're able to, make additional contributions as Roth and or voluntary after-tax contributions. This person, we're going to assume, has $100,000 of self-employment compensation. Again, self-employment compensation is line 31 of Schedule C, less 1/2 of the self-employment tax. Lastly, we're going to assume that all employer contributions are made as pre-tax contributions, because making employer contributions as Roth contributions offers no substantive advantage over making those contributions as Mega Backdoor Roth Solo 401k contributions, like we explained on the prior slides. So again, this person has $100,000 of self-employment compensation. Their goal is to first make contributions as pre-tax contributions to reduce their taxable income, and then, if possible, make any additional contributions as Roth or after tax. So for 2022, this person is going to make 100% of their self-employment compensation, dollar for dollar, up to $20,500 as a pre-tax employee. For 2023, they could go up to $22,500. In addition, they're going to make an employer contribution. Again, we're assuming as a pre-tax. That would be up to 20% of their self-employment compensation. So that's $20,000. So for 2022, and that's for both years, right? So for 2022, this person has $40,500 in their pre-tax solo 401k sub-account. They make the difference up to the overall limit. So that'd be another $20,500 as a voluntary after-tax for 2022, which they then move from the voluntary after-tax solo 401k sub-account to the Roth solo 401k sub-account. So now they've got $40,500 in their pre-tax solo 401k sub-account and $20,500 in their Roth solo 401k sub-account. For 2023, they're able to make $22,500 as a pre-tax employee, another $20,000 as a pre-tax employer, and then the difference up to $66,000 as a voluntary after-tax, which can then be transferred over to their Roth solo 401k sub-account. So now at the end of the day, they've got $42,500 in their pre-tax account to reduce their taxable income, and then another $23,500 in their Roth solo 401k sub-account. Again, this example highlights how with the voluntary after-tax contribution limit, it's 100% of the self-employment compensation, dollar for dollar, up to the overall limit, but reduced by any other contributions made to the solo 401k. So now let's change up the base scenario to $50,000 instead of $100,000 and see how that impacts how much we can contribute. It doesn't impact the employee contribution amount because we're still contributing 100% of up to that $20,500 limit for 2022 and $22,500 limit for 2023. It does impact the employer contribution amount. That employer contribution amount is 20% of self-employment compensation. So 20% of $50,000 is $10,000. It does impact the voluntary after-tax contribution amount. So this shows how you can't save more than you earn, right? So for the voluntary after-tax contribution limit, it's 100% of the self-employment compensation, $50,000, dollar for dollar, but not to exceed that amount, right? So you also then have to reduce it by the employee contribution as well as the employer. So for 2022, that leaves the ability to contribute $19,500 as a voluntary after-tax solo 401k contribution. And for 2023, that leaves the ability to contribute $17,500 as a voluntary after-tax contribution. Now let's go back to the base. The person now again makes $100,000, but here we're going to assume that the person maxes out contributions to a day job plan. So what does that leave them with the ability to contribute to their solo 401k? Well, they're not going to be able to make any employee contributions because they've already hit their limit under their day job plan. This example highlights how the employee limit applies at the employee level. They are going to be able to make both employer and voluntary after-tax contributions. So the employer pre-tax contribution amount is going to be the same as in the base scenario. It's 20% of self-employment compensation, 20% of $100,000, in other words, which amounts to $20,000. The person's going to be able to contribute 100% of their self-employment compensation, not to exceed the overall limit, as a voluntary after-tax contribution, but reduced by that employer contribution. So that means for 2022, they're going to be able to contribute $41,000 as an after-tax contribution. For 2023, they're going to be able to contribute $43,500. Excuse me. Actually, we skipped through that. Hold up 1 second. Excuse me, $46,000 for 2023. We've got a little, that should say 2023 there, but we'll clean that up in the slides. So it's $46,000 for 2023, $41,000 for 2022. 1 second. We can clean that up real quick so there's no confusion. Here we go. Okay, so that's the scenario where the person maxes out to their day job and how much are they able to contribute to the solo 401k. So at the end of the day, this individual is going to have $20,000 in their pre-tax solo 401k sub account. For 2022, they're going to have $41,000 in their Roth account. For 2023, they're going to have $20,000 in their pre-tax account and $46,000 in their Roth account. All right, now so let's go back to the base. The person doesn't make any contributions to another retirement plan. They're still making $100,000. But now they're not interested in making pre-tax contributions. They're only focused on making Roth or after-tax contributions. So in this scenario, the person is going to contribute their employee contribution, not as a pre-tax, but as a Roth contribution. So for 2022, they're going to be able to contribute $20,500. It goes into that separate Roth Solo 401k sub account. For 2023, they're going to contribute $22,500 because they're able to contribute 100% dollar for dollar of their self-employment compensation up to those different amounts. They're not going to make employer contributions because, again, we're assuming that the individual is not interested in making the employer contributions as Roth contributions because there's no substantive advantage of doing that when they can make the contributions as after-tax contributions. And they're not interested in making the employer contributions as pre-tax contributions. So that means they'll just skip ahead to make the rest of their contributions as after-tax contributions. For 2022, that leaves another $40,500, which can then be transferred over from the after-tax account to the Roth account. So at the end of the day, they end up with $61,000 in their Roth Solo 401k sub account. For 2023, that leaves $43,500, which they can then transfer from their after-tax account to their Roth Solo 401k account. So they end up with $66,000 in their Roth Solo 401k sub account for 2023. All right, so now let's go back to the base. Again, we're back to $100,000, but now we've got two participants. Let's say a husband and wife, they both work in the same business. Each person has the same profile, right? They're both under 50 years of age. They both don't make contributions to another plan. They're both looking to make pre-tax first, and then with whatever's left, make the rest as Roth or after tax. And each person has $100,000 of self-employment compensation. So for one person, Schedule C, it's going to show enough self-employment compensation to end up with $100,000 of self-employment compensation, and likewise the same for the other person. So the contribution amounts are going to be the same, but what this highlights is that each person is going to be able to make those contribution amounts. So for each person, they're going to be able to contribute $20,500 as a pre-tax employee for 2022. It goes up to $22,500 for 2023. Their employer contribution amount is another $20,000. That's the same for each year. In terms of the voluntary after tax, that leaves another $20,500 for 2022 and another $23,500 for 2023, which can then be transferred to either the Roth 401k or to a Roth IRA. Now let's go back to the base. Here, this person again has $100,000 of self-employment compensation. Their goal is to first maximize pre-tax and then do Roth or after tax. They don't make contributions to another plan, but now this person is 50 or older. So how does that change how much they can contribute? So everything is the same, except now they're able to make an additional catch-up contribution. So since their goal is to maximize pre-tax, we're going to assume that this person is going to make that catch-up contribution as a pre-tax contribution. So this is a good scenario to highlight that the catch-up contribution is made as an employee pre-tax or Roth. Here we're going to assume pre-tax because their goal is to first maximize pre-tax. For 2022, the catch-up contribution amount for this person would be an additional $6,500. For 2023, it would be an additional $7,500 because the catch-up contribution limit went up. So now let's go back to the base. The person's back to being under 50 years of age. Their goal, though, now is to only make Roth or after tax. But here, this person's maxed out contributions to their day job plan, right? They put in $20,500 for 2022 and $22,500 for 2023. So how much can they contribute to the solo 401k? Well, they're not going to be able to make any employee contributions to the solo 401k since that limit applies at the employee level. They're not interested in making employer contributions as pre-tax contributions because their goal is making Roth or after tax. And like we talked about before, making employer contributions as Roth contributions presents no substantive advantage of just simply making those contributions as after-tax contributions. So that means they'll just skip ahead and make all their contributions as after-tax contributions. So for 2022, they're going to be able to contribute up to $61,000 as an after-tax contribution. For 2023, they're going to be able to contribute up to $66,000. Okay, so now let's go back to the base. Now the person's back to being 50 or older. They max out to their day job. They're only focused on making Roth or after-tax contributions, voluntary after-tax contributions to the solo 401k. How much can they contribute? And as you can see, they're not going to be able to make any employee contributions to the solo 401k since they already maxed out to the day job. They're not interested in making employer pre-tax contributions to the solo 401k because their goal is Roth or after tax. So they'll just skip ahead and make all the contributions as voluntary after-tax contributions. So this is a good scenario in that it illustrates that even though they're 50 or older, the voluntary after-tax contribution limit doesn't go up, right? So they're still going to be able to make $61,000 for 2022 or $66,000 for 2023. Okay, so now let's keep tweaking the scenarios. Now we're back to having two participants, right? Two spouses, two business partners, right? The individuals are both under 50. Here they've maxed out contributions. They each have day jobs. They've each maxed out contributions to their day job plans. They're not interested in making pre-tax contributions, only Roth or after tax. And each person has $100,000 of self-employment compensation. So these individuals are not going to be able to make any employee contributions to the solo 401k. They already hit their limits under their day job plan. And remember, the employee contribution limit applies at the employee level. They're not interested in making employer pre-tax contributions. And so this scenario illustrates how each person's ability to contribute is based on each person's scenario. So here, each person's going to be able to contribute $61,000 as a voluntary after-tax contribution for 2022, or $66,000 as a voluntary after-tax contribution for 2023. All right, so that takes us to the scenarios. Hopefully that illustrates how those different rules work. Next, we want to highlight a very good tool on our website, which is our online calculator. You can find it by going to mysolo401k.net. There's a menu that goes left to right, home, about, solo 401k. If you go all the way over to the right, you'll find the drop-down menu under learn. And then if you click on online tools, you can quickly link over to the online calculator. When you're using the online calculator, you're first going to choose unincorporated sole proprietorship. You enter your net income from line 31. The calculator will reduce it by 1/2 of the self-employment tax. You enter your age, since that's one of the factors, and then it actually presents the different options and just highlights how with the solo 401k, you're able to contribute much more versus the other options that are out there. So with the solo 401k, you've got the highest contribution limits for any type of defined contribution plan available to self-employed individuals. Now, it's important to note that you would need to modify the calculator if you make contributions to a day job plan. It doesn't give you that option to enter contributions made to a day job plan. You'd also have to modify if you're looking to make after-tax contributions. And of course, we're here to help. We're fielding questions every day from our clients in terms of how much they can contribute and educating them on the contribution rules and how it might work for them. So once you've figured out, how much you can contribute, now you have to just decide within those limits how much you want to and are able to contribute. And then it comes down to actually depositing those contributions, making those contributions. So at a high level, you're able to make those contributions as either by check or by electronic deposit. Of course, the contributions have to be reported. So let's start to break down these different elements of making contributions. So if you want to make the contribution by check, you will make the check payable in the name of the solo 401k, and it's best to write annual contribution on the memo section of the check. From a solo 401k perspective, electronic deposit is certainly acceptable. Of course, mechanically, you want to check with the institution where the accounts are at, just to determine what their process is to make an electronic deposit to the solo 401k account. It's noteworthy that a lot of the brokerage firms where our clients' solo 401k accounts are at, their brokerage firm policy is not to allow electronic deposit from an external account where the name on the external account is not in the name of the plan, right? Say it's a personal account or a business account, with the one notable exception that Fidelity does allow for an electronic deposit from an external account where the name on the external account doesn't match the name on the account of Fidelity. In other words, the name on the external account is not in the name of the plan. So it's like that business account or that personal account. Fidelity would allow for that type of electronic deposit. Each participant is going to deposit his or her contributions into separate sub-accounts. As part of our onboarding process, we're helping our clients open up accounts, the requisite number of accounts at the bank or brokerage of choice. To the extent that you are making these different types of contributions, right? Pre-tax, Roth, or voluntary after tax, those need to go into separate sub-accounts. So we would ask our clients as they're onboarding, okay, you're looking to make Mega Backdoor Roth? Great. We're going to prepare the paperwork to open up 3 different accounts for you. When making contributions from a solo 401k perspective, it's perfectly acceptable to make those as one lump sum, or it could be in a series. Really, whichever interval you want is acceptable as long as it's made by the deadline, within the limits, into the different sub-accounts, etc. You can transfer the funds from a solo 401k perspective. It's perfectly acceptable to transfer the funds from a personal account or a business account, regardless of whether we're talking about an employee or an employer contribution. When is the deadline to make contributions? So per IRS publication 560, which is the landmark guidance for self-employed retirement plans like solo 401ks, as long as the plan was set up by the end of the year, you preserve the right to make all types of contributions, whether it's an employee, employer, voluntary after tax, anytime up until the business tax return deadline, including any timely filed extension. So for those who signed up with us before December 31st of last year and whose business is taxed as a sole proprietor or a single member LLC, that means you're looking at April 15th of this year or October 15th if you file a timely extension. And as a matter of fact, since April 15th falls on the weekend, you actually have until April 17th or October 16th if you file a timely extension. So this is a good chart as it shows the deadlines as well as the extended deadlines. And it illustrates how it depends on how the business is taxed. And it's noteworthy that that's for all types of contributions, employee, employer, as well as voluntary after tax. Now for 2023 contributions, as long as the plan is set up by the end of the year, that'll preserve the right to make those contributions up until the business tax return deadline for 2023 next year. So now you're looking at April 15th or October 15th if a timely extension is filed for those whose business is taxed as a sole proprietorship. In other words, the self-employment income is reported on the 1040, so that effectively your 1040 is your business tax return. How do I report contributions? So it depends on what type of contribution we're referring to. If we're referring to an employee contribution, which is made on a pre-tax basis, that's going to reduce the taxable income, which means it's going to be reported on line 16 of Schedule 1 of the 1040. If the employee contribution is made as a Roth contribution, then it's not reportable, not applicable. Likewise, if we're talking about a voluntary after-tax contribution, it's not reportable, not applicable. If it's an employer contribution that's made on a pre-tax basis, just like with the employee contribution, it's reportable on line 16 of Schedule 1 of the 1040. Roth contributions do not get reported on the tax return. It's also noteworthy that voluntary after-tax contributions, the actual contribution is not reportable, but remember what happens with that voluntary after-tax, those voluntary after-tax funds is that they're transferred either to a Roth 401k or a Roth IRA. In either case, the subsequent transfer is reportable on a Form 1099-R. So indirectly, they're going to be reportable, the subsequent transfer or conversion, but the contribution deposited itself is not reportable. What about matching contributions? Well, matching contributions don't apply to a solo 401k. They only apply to a full-time employer plan, right? A plan that has non-owner employees. Solo 401k contributions only consist of employee and employer non-elective profit-sharing contributions. So matching is when the employer matches what the employee has contributed. With the profit-sharing contribution, as we saw in the examples, there's scenarios where the individual is not able to make an employee contribution because they maxed out contributions to the day job plan. If with the profit-sharing contribution, though, it's not contingent on whether that employee contribution was made. So profit-sharing contributions may be made to the solo 401k, even if no employee contributions are made to the solo 401k. What is not a contribution? Well, it's always helpful to understand, and this question does come up because there are other scenarios where funds are being deposited into the Solo 401k account. So that can cause one to question, okay, do I need to consider this subject to the contribution limit and count this so to make sure I don't go over the limit? So it's good to highlight what's not a contribution and therefore not subject to the contribution limits. Number one, amounts rolled over from an existing retirement account, right? Let's say we're helping you transfer money from a former employer plan or a non-Roth IRA. This means you're going to get a transfer check to transfer those funds, which is deposited into the Solo 401k account. Obviously, that's a deposit into the Solo 401k account, but it's not a contribution, right? So you're able to roll over as much as you want from an eligible retirement account. Earnings from your Solo 401k investment, right? One of the popular reasons that clients are setting up accounts with us is the ability to invest in alternative investments, like say real estate. To use a simple example, someone might own a rental real estate property in their Solo 401k where the tenants are paying rent to the Solo 401k. So earnings are coming back to the Solo 401k account, being deposited into that Solo 401k account, which can raise the question, okay, is that considered to be a contribution that's subject to the contribution limits? And it's not. Earnings are not subject to the contribution limits because they're not contributions. Amounts converted within the Solo 401k. We've been talking a lot about Mega Backdoor Roth, where one makes voluntary after-tax contributions, which can then be transferred from the voluntary after-tax Solo 401k subaccount to the Roth Solo 401k subaccount. So now the funds are going to be deposited into that Roth Solo 401k subaccount. Is that considered to be a contribution? No. Therefore, it's not subject to the contribution limits. Likewise, when we're talking about in-plan pre-tax to Roth conversions, there's no limit on how much you can convert from a pre-tax Solo 401k account to the Roth Solo 401k account. It's not considered to be a contribution. Lastly, repayment of Solo 401k participant loans. Again, another very popular reason why clients are setting up accounts with us. Here, when you take a Solo 401k participant loan, you're literally taking funds out of your Solo 401k account, depositing it into your personal account, and then that loan has to be paid back according to the payment schedule. So you'd be depositing money from your personal account to your Solo 401k account. Is that deposit of money considered to be a contribution? No, it's not. You're just simply repaying your Solo 401k loan. So you don't have to consider it when determining whether you hit those contribution limits. All right, that takes us to the end of the slides we wanted to share. Again, we want to highlight the resources. We've got our community where we go live every day at 1 p.m. Pacific, 4 p.m. Eastern with our daily Zoom call. We've got 24/7 forums. We post videos every day on our YouTube channel, so please like and subscribe, continue to engage. Now we want to go through the questions that have been chatted over. Thank you so much for bringing the good questions and for the patience. All right, so we want to go through these sequentially. If you have a husband and wife combo running a couple of businesses structured as a sole proprietorship, what's the optimal way to structure the tax filing to be able to max optimize contribution room? Great question. So I'm understanding that they've got multiple streams of self-employment income, which is all being reported on a Schedule C or Schedule Cs. So from a solo 401k perspective, one is able to aggregate from multiple sources of self-employment income. And if it's all being reported as Schedule C income, you're just going to aggregate it all to determine what's that self-employment compensation. So really, the 401k rules and the contribution limits would not dictate how to structure your business. Of course, there might be tax or legal considerations outside of a 401k consideration, but from a 401k perspective, it's all going to go into one bucket and be used to justify contributions to the solo 401k. And again, regardless of whether the person is married, filing jointly or filing separately, each spouse's ability to contribute to the solo 401k is based on that particular spouse's self-employment compensation. So that particular spouse's own Schedule C, for example. Hopefully that helps. Thank you for bringing the good question. Say I have a W-2 job and max out my job's 401k. Also have self-employment income of $25,000. Would I be able to use a solo 401k and do voluntary after-tax contributions for a Mega Backdoor Roth? To clarify my question above, by max out, I mean salary deferral, assuming no small employer contribution. So great question. Thank you so much for bringing the good question. So I understand that in this scenario, the individual has a job through an unrelated employer, like say in corporate America, where they have a 401k plan, and then they might be contributing the max to that 401k plan at their day job, right? For 2023, let's say they contribute $22,500, assuming they're under 50 years of age. They've also got a separate line of self-employment work, which is, let's assume that there's no employees working for their business or any other business that's owned by that person or a spouse, if any, such that now they're eligible to set up a solo 401k based off of that self-employment activity. So the question becomes, how much can you contribute as a voluntary after-tax contribution? And as we saw with the scenarios and the discussion of the limits, the voluntary after-tax contribution limit is not reduced by contributions made to a day job plan. So that person is going to be able to contribute 100% of their self-employment compensation, which is their net income reported on line 31 of Schedule C, less 1/2 of the self-employment tax, assuming that their self-employed business is taxed as a sole proprietorship. So once they've run that pre-calculation to determine self-employment compensation, they're going to be able to contribute 100% dollar for dollar all the way up to the overall limit, which for 2023 is $66,000, reduced by any other contributions made to the solo 401k. Well, here they may not be making any other contributions to the solo 401k. Let's assume, they can't make any employee because they've already maxed out at their day job. Let's assume they're not interested in making employer because, they don't want to make employer as pre-tax contributions. They're only focused on after-tax. So they're going to be able to, and it's not reduced by contributions made to their day job plan because that after-tax contribution limit applies at the employer level. So it's not impacted by contributions made to their day job 401k plan. It'd only be impacted if that was a 403b, but here we're talking about a 401k in the example. So hopefully that helps. Thank you so much for bringing the good questions. Next question, if you have multiple Schedule Cs for different self-employment income streams, can you combine them when calculating your contribution limit? Yes, you could aggregate from all sources of self-employment compensation to determine your self-employment compensation and therefore to determine how much you can contribute to the solo 401k. Of course, you can't aggregate W-2 wages from your day job, but you aggregate all sources of self-employment compensation. So all those different Schedule C net income amounts. Thank you so much for bringing the good question. Is the optimal strategy for employer to make 20% profit sharing contribution to a pre-tax account in order to take a deduction to reduce income and tax, and then employee does after-tax contribution? It may be. I mean, that's where individuals have different approaches and different preferences and different strategies. But one is certainly able to make that hybrid type of approach like we saw with the scenarios, where they're first, say, maximizing the pre-tax benefit and then using whatever's left as an after-tax or a Roth contribution. Thank you so much. Hopefully that helps. Is there any requirement for the husband or wife to have a W-2 in order to be able to make any contributions? Not necessarily. You've got flexibility. What's required is really that for each spouse to be able to participate in the solo 401k, they're both working in the business and both reporting their own self-employment compensation. So they each have their own Schedule C, for example. They wouldn't necessarily have to be on payroll or get a W-2 from the self-employed business. It would be sufficient for them each to have their own separate Schedule C. And then each spouse's ability to contribute is based on their own self-employment income, their own age, whether that particular spouse is making contributions to another plan like a day job plan, etc. Is there any Is there an ability to look back at prior year's self-employment comp reported on the 1040 when a solo 401k didn't exist and claim cumulative self-employment income as a contribution room for current year? Great question. There is not. One really has to just use the self-employment compensation for that year that's reported for that year. Hopefully that helps. Thank you for bringing all the good questions. Is there any requirement for the husband or wife to receive a W-2? Right, so we talked about that. Great question. Yeah, each person has to have self-employment compensation, but it could be a separate Schedule C. Thank you for the good questions. After one makes a contribution to their after-tax account, how and when do they change that to a Roth? So one is able to contribute as one is able to make those voluntary after-tax contributions. We're assuming, they got the self-employment compensation, et cetera, and then convert either to a Roth 401k or to a Roth IRA. There's no triggering event. It can go either way. And so literally how it typically works is they just log in to their particular account and with the click of a mouse, move the money over. We have an online form where clients let us know about that after-tax to Roth transfer. We've got one form if it's an after-tax to Roth Solo 401k. We've got another online form if it's an after-tax to Roth IRA to capture that information, because that is a reportable event, right? It's not taxable if we're talking about after-tax dollars, which we are, so it's not taxable, but it is reportable. So we have an online form to gather the information we need to prepare the 1099-R, which we handle as part of our service for no additional charge. Thank you for bringing the good question. Is transferring funds from an after-tax titled bank account to a Roth titled account at a crypto exchange the right way to transact a Mega Backdoor contribution? No, the best way is to go first after-tax bank account for the Solo 401k to Roth bank account for the Solo 401k, and then Roth bank account for the Solo 401k to the Roth account at the crypto exchange that's in the name of the Solo 401k. Is it necessary to allocate, say, 50% of the self-employment income from Schedule C to each of the husband and wife in order to give them each max contribution potential? Well, that's a great question. Really, the threshold question you're asking, right, is how to report the income, which one has to answer that question regardless of whether they have a 401k. Once you know the answer to that question, right, how this is going to be allocated between the husband and wife, right? So you'd have husband with one Schedule C with a certain percentage of the self-employment income, wife with another Schedule C with the rest of the self-employment income. Now the tax advisor might say, hey, there's flexibility. It's not set in stone. And then you might be able to do some type of analysis, right? Like if one spouse is above 50 years of age, then they're going to be able to make the catch-up contribution. Or if one spouse has a 401k day job where they're maxed out at their day job, you might then take that information in consultation with the tax advisor to adjust accordingly. If one of them already has a maxed out day job, is it more advantageous? So it depends on what you're trying to accomplish, right? If the goal is to make pre-tax contributions only, right, or first at least, and you've already maxed out to the day job, your only ability to make pre-tax contributions to the Solo 401k, as we saw with the examples, is as an employer contribution, where the limit is not dollar for dollar, it's a percentage. It's 20% of the self-employment compensation. Whereas if one of the spouses has not made contributions to a day job plan, they're going to be able to contribute 100% of their self-employment compensation dollar for dollar up to that employee limit, right? For 2022, assuming they set up the plan by the end of December, they're going to be able to contribute $20,500 as an employee, plus an additional $6,500 catch-up if they're 50 or older, 100% dollar for dollar. So that spouse is going to be able to get faster to that pre-tax contribution limit. If the goal is after tax, though, it's still dollar for dollar. So there isn't a particular advantage or consideration there. But if you're looking at pre-tax, that could be a consideration. Good questions. There you go. Exactly. Hopefully that helps. I have funds liquidated into USD sitting in Gemini. I want to open a Roth Solo 401k crypto account. Do I need to transfer the money over to my Solo 401k account and then back to Gemini to be legit? Exactly. When you make a Solo 401k contribution, it's made to a bank or brokerage account opened up under the name and the EIN of the Solo 401k. Of course, assuming that one is self-employed with no full-time, non-owner, non-spouse employees working for any business owned by that person or a spouse, if any. And then once the contribution, subject to the limits, et cetera, then once the contribution is made to that Solo 401k bank or brokerage account, then it could be transferred out for an investment, like to a crypto exchange account. I've opened all 3 accounts for my Solo 401k using the EIN you gave me. I've already made some deposits. No, so making contributions is not reportable by the plan. So clients do not have to get our approval or let us know when they make contributions. Of course, we're here to help to educate in terms of the limits or the mechanics and all the different issues, for example, we've been going through, but there's no requirement to let us know when you make those contributions. Sending out funds to brokerages, I'm concerned if I'm missing any steps in the process. So I think we might have addressed it in the answer up above, but it sounds like you have 3 separate accounts opened up under the name of the EIN of the plan. Let's assume that it's at a bank or at a brokerage. So those contributions would go as applicable into the applicable account, and then from there it could be transferred out to the account at Gemini. So let's just say you have a Roth Solo 401k, you have an account at Gemini under the name and EIN of your plan, which is for Roth money. Let's assume you're trying to make a Mega Backdoor Roth contribution. Let's assume you have a brokerage account for voluntary after-tax contributions opened up under the name and the EIN of the plan. Let's assume you got a Roth brokerage account for the Solo 401k. So one could make a voluntary after-tax contribution subject to the limits, the deadlines, etc., transferred from the voluntary after-tax brokerage account to the Roth brokerage account or bank account, and then transferred out to the Roth, to the account at the exchange for Roth Solo 401k funds. Hopefully that helps. Thank you for bringing the good questions. So it's easy to move the funds from the Solo Roth through you to the Roth IRA at Schwab, not distributable event required. Can you riff on how that works, please? So if you're trying to transfer money from the Solo 401k to a Roth IRA, one is able to do so without a triggering event if the money that's being transferred out is a voluntary after-tax contribution, right? Voluntary after-tax funds could be transferred out of the plan to a Roth IRA with no triggering event required. And so if the Roth IRA is at Schwab, and that's the ultimate destination, what typically would happen is that we would help the clients open up a voluntary after-tax brokerage account at Schwab into which the contributions are deposited. And then from there, it's easy. We've got a procedure page, etc., to transfer funds from the voluntary after-tax brokerage account at Schwab to the Roth IRA. If the funds that are in the Solo 401k are in a Roth Solo 401k account, though, you have to meet a triggering event before you can transfer those out to a Roth IRA. So if the goal is ultimately to get the money to a Roth IRA, one wouldn't want to make the Roth contribution as an employee contribution or an employer. This is one of the examples of why there's no substantive advantage of making the employer contribution as a Roth contribution under the new Secure Act 2.0 rules, because you got to meet that triggering event before you could transfer it out to a Roth IRA. So one could simply skip making the employee contributions as a Roth and subject to the limits, etc., just make all the contributions that they're looking to transfer to the Roth IRA as an after-tax contribution and then transfer out to the Roth IRA at Schwab. So hopefully that helps. Thank you so much. I understand. Yep. So the checkpoint under the date under which you have to determine the value for 5500 EZ reporting purposes is December 31st. So if the value is always less than $250,000 as of December 31st, there's never going to be a 5500 EZ filing requirement. Hopefully that helps. Does the Solo 401k plan have the ability to allow me to move funds from my voluntary after-tax Solo 401k sub account to a separate Roth IRA account outside of the Solo 401k? The answer is yes. I'm understanding if you could transfer money out of your voluntary after-tax Solo 401k account to a Roth IRA. Like per the discussion up above, there's no triggering event. We can go to any Roth IRA you have, right? It could be an existing Roth IRA, it could be a new Roth IRA, etc. Hopefully that helps. So with these accounts that we're helping our clients open up at hundreds of different banks, many different brokerages, such as Fidelity, Schwab, TD Ameritrade, the role of the financial institution is just to provide the account. So they're not policing the account, for example, from a 401k perspective. It's not as if it's their 401k plan. So the answer is, so they are not reporting transactions, for example, to the IRS. So we handled the 1099-R reporting to report the transfer from the after-tax account to a Roth IRA. And Schwab is a very, very popular option. We've got many, many clients that are doing it at Schwab. So yes, it's certainly going to be able to be done. All right, so that takes us to the end of the questions, it looks like. Thank you so much for all the great participation. Please continue to engage. We'll be having more, so please stay tuned on the YouTube. If you subscribe, like, you'll get notifications. We go live every day at 1 p.m. Pacific on our community, mysolo401k.net/my community. We've got forums where you can post questions 24/7. Again, we have host Zoom calls, et cetera, et cetera. All right, so if I open a Gemini Roth account, I can or cannot just fund it with the Roth money I already have on the platform. No, you cannot. You need to make the contribution to the Solo 401k bank or brokerage account. And then from there, transfer to the Gemini account. So 5498, Form 5498 does not apply to a Solo 401k. It's not, per the instructions, it's not able to be issued by a plan. That applies to an IRA, and there's no analogous form. This is just more technical detail to align to what I was mentioning up above about why our clients don't have to let us know how much they're contributing, because it's not reportable by the plan. It's reportable on the business or personal tax return, of course, especially depending on the type of contribution, like we saw, if it's a pre-tax contribution, but the contributions are not reportable on by the plan. 5498 does not apply. So if you're making a voluntary after-tax contribution, which is then transferred to a Roth IRA, the transfer out is reportable on a 1099-R. We have an online form the clients use to let us know. The 5498 would be issued by the Roth IRA provider with respect to the Roth IRA. Okay, awesome. Thank you so much. Appreciate everyone's great participation. Thank you so much. Take care.